Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. It's January 2025. In this video, I'll discuss how the exceptional concentration in the S&P 500 index has likely made it a suboptimal way to invest in the US stock market going forward. For listeners who know Atlas Capital, you may be surprised that the suggestion is coming from us. In the past 10 years, the S&P 500 index has been a very good way to gain exposure to the US stock market. In fact, in the 10 years ended June 2024, only 4% of the active large cap core funds that were benchmarked to the S&P 500 index beat that benchmark, according to S&P Global Indices. As we have often argued, why bother with hiring active stock managers when the odds are overwhelming that you'll have a better outcome with a low-cost index fund? But are the odds overwhelming going forward? In the composition of the S&P 500 index, the weight of each stock is proportional to the stock's total market value or market capitalization, and therefore the companies with the largest market value have the largest weight in the S&P 500 index. In the last 10 years, the companies with the largest market value have also been great performers. On average, they've had about twice the average annual return as the average US stock. So a good way to have beaten the S&P 500 index in the past decade would have been to have a very concentrated portfolio in a handful of the biggest stocks like Nvidia or Microsoft. But that's an unnatural thing for an active equity manager to do, to have an undiversified portfolio of big technology companies who share risk factors, and as a result, most active managers have done worse than the index. Because the largest stocks have been winning, the 10 largest are now almost 40% of the entire value of the S&P 500. That's an extraordinary level of concentration in the index. 10 years ago, the top 10 companies were less than 20% of the value of the index. So can the top 10 stocks continue to have the best returns? Well, for that to happen, then these following criteria are needed. The index weight of the top 10 companies must continue to rise from the record high of 40% of the index to something even higher. For the most part, the companies that are now in the top 10 would need to hold on to their positions in the top 10. The top 10 giants would need earnings growth at least as good as the earnings growth of the index. And moreover, if PE ratios of the top 10 companies become more similar to the PE ratios of other companies, then the earnings growth of the top 10 would need to be still higher for them to continue to have good performance. That's what's been happening for the last few years, and it doesn't necessarily stop happening at this moment, but in the long run, the criteria listed here are very hard to sustain. Usually, the biggest companies have done worse than the index. In the 57 years from 1957 to 2014, the performance of the top 10 stocks was about 4% per year worse than the performance of the average stock. The last decade has been a huge outlier from this normal historical pattern. The reason the top 10 do worse is that companies just can't keep up the rate of growth that got them to the top 10, and so then they fall back out of the top 10. This page shows the top 10 stocks in the index in 1984 and in every 10 years thereafter. On average, about half of the top 10 dropped out every 10 years. Microsoft is the only company that's in today's top 10, which was also in the top 10 20 years ago. In this chart, the orange line shows the weight of the top 10 in the S&P 500 index. We can see now that the index is as concentrated as it has ever been. In 1964, the the last time that the index was so concentrated, it would have turned out to be a bad idea to own the top 10 because those companies went on to fall out of the top 10 and become a much smaller proportion of the S&P 500 index. The great recent performance of the top 10 has been propelled by an escalation of price-earnings ratios for those companies. At 36.6, the PE ratio of the top 10 is almost double the 19.3 PE ratio of the average stock. That implies that the earnings growth for the largest stocks needs to be 2.5% per year faster than for the average stock forever. But that's unlikely. Usually, the largest companies have lower than average earnings growth, which is why they tend to fall away from the top 10. Because of the rich price-earnings ratios of the largest companies, a gap has emerged between the PE ratio of the capitalization-weighted S&P 500 index and the equal weight S&P 500 index. Usually, those PE ratios have been similar. If this gap closes, then it would be bad for investors in the top 10 stocks and in the S&P 500 index. So to summarize, the dominance of today's top 10 stocks is unusual in stock market history. The reasons why the top 10 have been winning, the better earnings growth, the escalation of price-earnings ratios, they're not likely to be sustainable in the long run. Therefore, we believe the equal weight S&P 500 index will likely outperform the capitalization-weighted S&P 500 index over the next 5 to 10 years. Even better, you could do what Atlas Capital does for our clients and have a diversified portfolio of stocks selected based upon systematic criteria validated by academic and industry research. So thanks for listening. To get other recent market commentary, be sure to watch the market commentary playlist on this channel. And don't forget to subscribe to get notified as soon as the latest is posted. You may also visit our website at atlasca.com. Thank you.